Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today, we're going to discuss what is a put option. We're going to talk about how it can be used to protect the price of a stock that you own. And we're also going to be talking about how you can use it by itself if you are bearish on a stock. Now, before we get into the put option itself, we want to review the stock risk reward graph that we see right here. On this, you'll see that you can buy a stock at $20 per share, and you can see as the price of the stock goes higher in value, you will make more money. If the price of the stock went from 20 to 30, if you had 100 shares, of course, you'd be up $1,000. This doesn't include commissions and taxes, of course. If the stock were to go down $10 a share, you would be down $1,000, roughly half of the money with which you invested. So there's a good thing and a bad thing to all parts of investing. With the stock, if it goes up, it's good. If it goes down, it's bad. What a put option can do is help you to shift your risk in a very unique way that you may or may not be aware of. Let's take a look at what a put option can do to possibly help protect the stock in a way you might like. Now, the first thing that needs to be mentioned is that you can select different strike prices or different expirations for your put option. It kind of works like term insurance in that if you have a term life policy for 10 years, let's say, you pay your premium to the insurance company. If the insurance company wants to win this, you're going to have to live all 10 years. Now, in reality, it is kind of a win-win situation because if you live 10 years, you don't die. But once the 10 years are up, then the insurance company's obligation is done. And you just paid the insurance company money for something that you didn't need, but you're probably glad that you had. With a put option, just like a call option, you can select different time frames and different expirations. In this example that we are showing right here, we are doing this 6 months out and we are doing it at the money. That means that the stock price is at 20. We're buying the 20 put option, meaning it's right at the money. And we're going 6 months out. It's not shown on the screen, but you can just take my word for it. That's what we're doing. With this example, I want to show how you actually can have price protection. We're going to assume that we bought 100 shares of stock, giving it at $20 a share. That gives us a $2,000 investment. $150 is what we're paying for the price of the put option. That acts just like insurance. So as you can see from the risk reward graph, as the price of the stock goes higher, you get to participate on the upside right along with it. If the stock goes to 20, 30, 40, 50, whatever, you get to participate by owning the stock. Where the put option comes into play is if the stock goes lower. If the stock goes lower, you have the right, but not the obligation to sell the stock at 20, regardless of the price. So if the price of the stock is at $10 per share, normally you would have lost half your investment. If you own the put option, you actually have the ability to sell the stock at 20, even though it's at 10. There's somebody on the other side of the trade that sold you that right. Now, what's the disadvantage to owning a put option? Well, the first thing that needs to be said is that this is all about shifting risk, meaning that $2,000, we don't have that much risk anymore because we have the put option. Where the risk comes into play is the price that you paid for the put option. So if the price you paid for the put option, as you can see, $150, if the stock goes higher, you're out that $150. If the stock stays the same, you're out that $150. If the stock goes lower, then you have that right to sell it, and it may have come into play. It's just like buying insurance. In this case, you're buying price insurance. And sometimes it makes sense, sometimes it doesn't, just like anything in all of investing. Now, the next thing we're going to talk about on how you can use a put option is you can use it if you have a bearish sentiment. So let's take a look at what owning this specific put option would look like if I was bearish on this same stock and didn't own it. I just wanted to profit from the put option going down in value. So now we're at a stage where we want to use a put option in another way. We want to use it to profit from the value of the stock going down in value. Now, in this risk reward graph, we're seeing just the put option and no stock. We do not own the stock in this example that I'm showing right now. We are in cash and we think that XYZ stock is going to go lower. And so to express our sentiment, we're going to buy this put option. Once again, we're buying a 6-month at the money put option, the $20 strike price, and 6 months out. And that means that we have 6 months for this to work. Now let's start with the disadvantage. If the stock stays the same or goes higher, you're out $150, you lose 100%. That's pretty simple. Where can this come into play as an advantage? Remember, if the value of the stock goes lower, you have the right, but not the obligation, to sell that stock at 20, even if it is at 10, 15, 12, whatever the case may be. And because you'll have that right by owning that put option, if it goes your way, the value of the put option will increase in value. So when you have the stock at 13, the put option mathematically has to be worth $7, or in this case, $700. So, and it will likely be worth more because of extrinsic value. So this is something to where you can sell the put option on the open market for a profit when the stock goes down in value. Keep in mind the stock has to go down enough in value. If it goes down a penny, you won't necessarily make any money. And also make sure you have a good understanding of time decay and implied volatility, which we'll cover in a future video at some point. What I want to emphasize today is that you have the choice to exercise a sentiment when you don't own the stock. And that's what a put option can do for you and how it can possibly benefit you. Those are the two main uses that we covered today. There's others, as in how you can use them in spreads and selling puts initially and things like that, but those will be covered in future videos. And finally, if you enjoyed this content, please subscribe. This is a way with which the content can get out to greater audiences. Also, if you're interested in working with a financial advisor who's not afraid of the option product, who does strategies like this and even more advanced strategies, feel free to reach out to me at my website, stcharleswealth.com. You can also follow me on Twitter at Mike Tusaw. Thank you and have a wonderful day. Bye-bye.